Jason, how you doing, buddy?
Good.
Okay, you got a piece coming out tomorrow?
Yeah.
People are flocking to junk bonds again.
Yes, big time.
But no matter how often you try and put out common sense investing wisdom to people, they insist on running headlong into the next big disaster. Is there going to be a problem in junk bonds?
I don't think it's going to be a disaster, Evan. I think the issue is that a lot of people's expectations are sort of miscalibrated. I guess that's a diplomatic way of saying people think they're going to get a little more than they probably will.
Right. So if I'm buying a junk bond now, and I know we're going to get to the ETF angle in a second, but if I'm buying a junk bond now, which is a high yield bond, it's a lower credit quality bond, and I'm buying it really there are two things that can affect this bond. One is the credit quality of the company, and the other is the interest rate risk that I'm taking right now.
Correct.
So I think I'm getting 5% great yield on this bond because it's lower credit quality.
Right.
But what if interest rates spike?
Well, you'll be hurt the same way you'll be hurt in any bond.
Right.
You'll be hurt somewhat less probably in a high yield bond because they tend to be a little less sensitive to interest rate spikes in isolation.
Right.
But if an interest rate spike triggers a recession or is otherwise part of an economy that isn't doing well, then your junk bond is going to get hit hard.
Right, and so far, whereas treasuries this year, probably if you own a long-term treasury bond or a long-term treasury ETF, you're probably lost money, just in terms of face money. But in high yield, not necessarily, because you're getting a higher yield and there's been a tightening in spreads along the corporate side.
I mean, junk bonds are up, 5.5% so far this year, and that's not a bad return for an entire year, and we're in the middle of March.
Right. But spreads have come in quite a bit. I mean, the general sentiment in the market is the economy's improving, so credit quality among these junk companies, the junk bond companies, is improving, and so that's leading to tighter spreads, but you still are taking the interest rate risk.
Yes, you are, and of course you're taking credit risk too, because, I mean, there's a reason these companies have to issue bonds at higher than market interest rates.
Now, your piece, you take on this issue of, if you were interested in junk bonds, should you buy junk bond ETFs? And you raise the issue here that in effect you're overpaying when you buy the ETFs. Did I get that right from the piece?
Yes, except I would make it conditional. You can be overpaying. You also can underpay, which would be great.
Right.
Right now, the major junk bond ETFs are trading at a slight premium, meaning you're paying a little more than $100 for every $100 in bond assets they hold.
Right.
Last fall, they were trading at discounts. In some cases, you might have been paying $97 for $100 worth of bonds. The trick is if you're interested in high yield and you want to get in it through an ETF, you really have to watch that premium and discount.
Right. Why wouldn't somebody just buy, like a no-load, kind of indexy type high yield corporate bond fund, instead? I mean, what is the downside of going with something like that?
There isn't much of one. The problem is there aren't a lot of those funds available. Vanguard has one. There's a couple others, T. Rowe Price, Fidelity, but they're not as easy to come by. The ETFs are out there. They're really big. They're very liquid. They're easy to buy and sell.
Right. Last question. Generally, people should be a little careful right now. I don't want to put words in your mouth, but you would kind of advise a little bit of caution here as you plow into the high yield market right now?
Yeah, I think you have to ask yourself, why have the two major high yield ETFs grown by a third in less than 3 months? Maybe there's a lot of people crowding into the space.
Jazon Zweig, the intelligent investor. Check out his piece in tomorrow's Wall Street Journal. It's probably online already or later today.